T-Mobile completely beat consensus this quarter. Total revenues hit $22.79 billion, which is up 8% year over year. Diluted EPS came in at $2.99, up 5%, and that actually includes a 14-cent negative impact from the U.S. cellular merger costs.
Yeah, and the market absolutely loved it.
Oh, totally. The stock popped immediately because the guidance raises just came in hot right out of the gate. Core adjusted EBITDA is raised to a range of $37.1 to $37.5 billion.
Right, a massive raise.
Postpaid net account additions are raised to between 950,000 and 1.05 million. And adjusted free cash flow is now expected between $18.4 billion and $18.8 billion.
So a huge top-line beat and, very aggressive forward-looking projections.
Exactly. Guidance is up, revenue is up, and the PR team is taking a massive victory lap today. But if you actually strip away the fluff from their Q2 Form 10-Q and the press release...
Which is what we always do.
Right. You find some really interesting cracks, shrinking account additions, soaring bad debt, and a pretty massive pivot away from the exact thing that made them famous.
Yeah, it's a completely different story under the hood.
It really is. So our mission today for you, the retail investor, is to do a deep dive into those segment details. We're going to analyze the actual margins and evaluate whether the underlying cash flows justify all this, frankly, extremely bullish management commentary.
Well, looking under that hood reveals a pretty stark divide in how T-Mobile is actually getting that 8% total revenue growth. Like, total service revenue hit $19.0 billion, a 9% increase.
Okay, that sounds great on the surface.
Right, but the engine pulling that entire train is basically just postpaid service revenue. That generated $15.9 billion, which is up 13% year over year.
Wait, so meaning the rest of the business is actively dragging them down?
Yeah, precisely. The filings show prepaid revenues actually fell 6% down to $2.47 billion.
Wow.
Yeah, it's driven by lower average revenue per customer from, promotional dilution, and wholesale dropped 8% too.
Wholesale dropped 8%.
Yeah, the 10Q specifically calls out lower MVNO revenues.
Ah, mobile virtual network operators.
Exactly. So companies like DSH or TracFone, they don't own their own towers, right? They just pay to piggyback on T-Mobile's infrastructure. So when those companies lose subscribers or renegotiate their rates, T-Mobile's wholesale revenue takes a direct hit.
That makes sense. I want to focus on that postpaid dominance, though, because, that is where management is pointing all the spotlights right now.
Oh, absolutely.
The key metric they are parading around is ARPA, average revenue per account. Postpaid ARPA grew 2% to $152.91.
Which, sounds fantastic.
It sounds fantastic until you look at the raw volume. Postpaid net account additions for the quarter were 277,000. That is a 13% drop year over year from the 318,000 they added in Q2 of last year.
Right. A pretty significant slowdown.
And on top of that, postpaid churn actually ticked up 7 basis points to 0.99%. So, we're seeing fewer people walking through the front door and slightly more sneaking out the back.
Yeah, it's an undeniable trend.
So I have to ask, are they just squeezing their existing base for higher ARPA to mask the fact that raw volume growth is hitting a wall?
The underlying mechanics certainly point to yield optimization over pure land grabbing. Like, the filings cite, and this is a, quote, higher fee revenue, including from the adoption of new tax and fee exclusive plans.
I'll be interested.
Yeah, it's listed as a primary driver for that ARPA increase. So in plain English, they are migrating customers to rate plans where taxes and administrative fees are passed directly to the consumer.
Right, rather than being baked into the advertised price like they used to do.
Exactly. It functions as a stealth price hike. It increases the yield per account without officially raising the base sticker price.
Which perfectly explains why they're making more money from fewer new accounts.
Yeah.
But what about that 0.99% churn? For a company that historically prided itself on unparalleled customer retention.
The uncarrier stuff.
Yeah. Creeping up toward that 1% threshold, that feels like a huge red flag.
Well, you have to segment out the broadband customers to really understand that churn dynamic.
Oh.
The filings actually attribute the higher churn directly to the growing base of broadband-only accounts, which includes the recent integration of those Metronet customers. Broadband churn behaves fundamentally differently than a mobile phone churn.
Because of the physical friction involved, right?
Exactly that. Just think about the physical mechanics of it. Switching your cell phone carrier usually just involves swapping a physical SIM card or, downloading an eSIM from your couch.
It takes like 5 minutes.
Right. But switching home broadband, you're scheduling a technician, waiting during a 4-hour service window, drilling holes in drywall to run fiber optic lines.
Setting up a new router, breaking a contract with your cable provider, It's a nightmare.
Right. The friction of installation is incredibly high, so broadband customer acquisition is slower. However, once they're installed, those customers are incredibly sticky.
So the churn spike is just temporary.
Yeah, the initial spike we are seeing is just the friction of integrating these new broadband portfolios and shaking out the lower tier or promotional customers.
Got it. And that dynamic of squeezing more value out of a smaller volume of transactions, that's showing up in their equipment sales too, isn't it?
Oh, definitely.
Equipment revenues ticked up 2% to $85 million, but total prepaid device sales actually dropped. They achieved that revenue increase because the average revenue per device sold was higher.
Yeah, they are financing fewer raw phones, but they're aggressively pushing the ultra-premium $1,000-plus models.
Which I assume serves a dual purpose.
It absolutely does,
Uh-huh.
because a customer financing a premium device on a 24-month or 36-month installment plan is essentially locked into the ecosystem.
Oh, the hardware becomes a retention tool.
Exactly. It mirrors the service strategy perfectly. Lower raw transaction volume, but much higher monetization and lock-in per unit.
Okay, so you mentioned earlier that they're squeezing more revenue out of premium devices and higher tier rate plans. But scaling that premium experience comes with a massive bill.
It's very expensive, yeah.
If we look at the margins and the cost of doing business,
Yeah.
keeping this revenue engine running is creating some serious pressure points. Core adjusted EBITDA jumped a healthy 12% to $9.537 billion.
Yeah.
But total operating expenses increased by $1.4 billion.
Yeah, that 9% jump in operating expenses tells the real story of the quarter. Cost of services alone increased 10%, adding $261 million in expenses.
Wow. Where's all that going?
The primary drivers there are wholesale network access costs and the immediate financial friction from the U.S. cellular acquisition. We also see the amortization of customer installation fees for their new fiber joint ventures, Lumos and Metronet, hitting this line item.
And then there's SG&A selling, general and administrative expenses, which rose 8%, hitting the balance sheet with an extra $437 million in costs.
Yeah, and there's a glaring red number in there.
The bad debt expense, right?
Exactly. Bad debt hit $398 million this quarter.
That is huge.
It is a massive jump from the $265 million they reported in the exact same quarter last year. Combine that with the costs they're incurring for closing legacy retail stores, and you really start to see the strain.
Yeah. We also cannot ignore depreciation and amortization, which jumped to 9%, or $288 million.
Right. They are aggressively building out the 5G network.
But more importantly, they are accelerating the depreciation of U.S. cellular assets, right?
Yeah.
Like, as part of the restructuring, they are writing down the value of redundant network and technology assets much faster than normal.
That's spot on.
You know, it's like renovating a house while you're living in it.
Huh. Yeah, that's a great way to look at it.
Right. Like the GAAP net income is the messy living room covered in drywall dust. It looks terrible right now because you're actively paying the contractors to tear up the floorboards, which is the U.S. cellular integration and closing retail stores.
Exactly.
But the adjusted free cash flow is the actual structural value of the home, which is skyrocketing. So investors kind of have to decide which room they are sitting in.
Yeah.
Because all of this immediate out-of-pocket friction means that while top-line growth looks stellar, short-term GAAP net income only grew 1% to $3.239 billion.
And the accounting mechanics of your house renovation analogy are perfectly accurate. That GAAP net income of $3.2 billion includes $146 million in accelerated depreciation, net of tax, purely from U.S. cellular merger-related costs.
Right.
When management executes a gut renovation of the asset base, shutting down redundant towers, combining billing systems, the GAAP net income will always be suppressed by those one-time structural costs. It completely masks the cash-generating power of the underlying business.
Which is exactly why management is leaning so hard into a specific narrative to justify all this drywall dust. I mean, CEO Srini Gopalan spent a significant portion of the release highlighting a record-high wireless net promoter score of 46.
Yeah, they love talking about that.
Right. That is the highest ever NPS for a Big Three carrier, according to the HarrisX survey data. They also swept the Network Awards Ookla Best Mobile Network, and OpenSignal awarded them every single quality of experience category.
Well, management is utilizing those third-party network awards as the strategic justification for their pricing power.
Oh, so.
The underlying logic is that superior network engineering and, lower latency metrics allow them to migrate customers to those tax and fee exclusive plans we discussed earlier.
Oh, I see. You can only act like a premium brand if the network performance actually validates the premium price tag.
Exactly.
But they are taking that premium brand and moving it far beyond just cell phones. And this is where the structural economics get really fascinating. T-Mobile is aggressively pivoting into broadband through these massive fiber joint ventures.
Yes, the fiber play.
They invested $932 million for a 50% equity stake in Lumos to build a fiber-to-the-home platform. They bought into Metronet. And they just announced a new joint venture with AT&T and Verizon to map out and eliminate rural wireless dead zones.
Which is wild, but the joint venture structure is a complete masterclass in capital efficiency.
Oh, totally.
Because laying fiber optic cable is one of the most capital-intensive activities on Earth. You are physically trenching roads, securing municipal permits, laying glass underground.
It costs a fortune.
It does. So by utilizing off-balance sheet joint ventures, T-Mobile lets their partners, like private equity firms or specialized infrastructure builders, handle the heavy lifting of network engineering and deployment capital.
So they completely avoid destroying their own balance sheet with the raw construction costs.
Precisely. It's the exact opposite of the traditional telecom model. T-Mobile retains the customer relationship. They slap the magenta T-Mobile logo on the router in your living room, they handle the billing, and they recognize the recurring service revenue.
All while funding only a fraction of the actual infrastructure built.
Exactly. And the joint venture with AT&T and Verizon operates on a really similar logic. I mean, competing to lay redundant fiber lines in sparse rural zip codes makes zero economic sense for any of them. Pooling capital to build a single shared backbone allows all three to expand their total addressable market without destroying their individual margins.
That is brilliant.
Yeah.
But they still need massive amounts of internal cash to fund their side of these joint ventures.
They do.
And that brings us to the restructuring. Because looking at these three restructuring hits, the workforce cuts, the store closures, the cell site decommissioning, this doesn't look like just routine house cleaning to me.
What does it look like?
It looks like they are frantically sandbagging their margins to afford this expensive new fiber strategy. Am I reading too much into this?
No, you're not. You are identifying the dual mandate of modern telecom management. On one hand, yes, there is standard post-merger synergy realization.
Sure, from U.S. Cellular.
Right. When you integrate them, you inherently acquire duplicate cell towers and redundant middle management layers. They took a $182 million hit to EBITDA this quarter just to begin severing those redundancies.
Okay, that part is normal.
And the Workforce Transformation Initiative has already cost $141 million to centralize leadership and flatten the organization.
But the retail store closures feel entirely different. They took a $108 million pre-tax charge to close smaller dealer stores and transition to, quote, large format experience stores.
Yeah, that is a big pivot.
That is not just eliminating redundancy. That is fundamentally changing how they interact with the consumer.
It really is a profound shift in retail psychology and, operational overhead. Smaller, independent dealer stores in strip malls rely on commission splits and offer really limited inventory.
Right.
By paying the upfront cost to break those leases, which is that $108 million charge, they are transitioning to massive corporate-owned experience stores, very similar to the Apple Store model.
Where you walk in to buy a phone and they sit you down in a living room mock-up to sell you home broadband.
Exactly. The cross-selling potential is exponentially higher there. And more importantly, large format stores consolidate foot traffic, so they require fewer overall retail employees and lower long-term real estate overhead.
So, my sandbagging theory.
So to answer your thesis, yes, they are actively sandbagging their margins. By cutting the long-term operational fat out of their legacy mobile business, they are generating the free cash flow required to fund the multi-$100 million capital calls for the Lumos and Metronet fiber builds.
Which brings us to the ultimate scorecard for any retail investor. Capital allocation and the balance sheet.
The fun stuff.
Exactly. Because despite the $398 million in bad debt and the hundreds of millions in restructuring friction, the cash flow engine at T-Mobile is running incredibly hot. Net cash from operating activities hit $7.5 billion for the quarter.
Which is a 7% increase year over year.
Yep.
And even after factoring in $2.7 billion in cash purchases of property and equipment, which is the actual capital expenditures required to maintain the 5G network and integrate U.S. Cellular, their adjusted free cash flow grew 4% to $4.8 billion.
$4.8 billion in clean free cash flow in a single 90-day period. The immediate question for retail investors is, where is that cash going? And the answer is aggressive, unyielding shareholder returns. They deployed $3.3 billion in Q2 alone, They spent $2.2 billion buying back 11.4 million shares of their own stock at an average price of $188.76.
That's massive.
And they paid out $1.1 billion in dividends.
The scale of the capital return program is honestly staggering. The board already increased the 2026 stockholder return program to $18.2 billion.
Wow.
And management's forward-looking business plan projects deploying up to $30 billion for share repurchases and cash dividends from January 2026 through the end of 2027.
$30 billion.
$30 billion. Returning that much in 24 months requires absolute, unshakable confidence in the sustainability of their recurring revenue.
But unshakable confidence cannot ignore absolute leverage. You cannot look at a $30 billion buyback program without looking at the other side of the ledger.
Very true.
The balance sheet carries a staggering $78.5 billion in long-term debt. Now, management will obviously point out that liquidity is strong. They have $2.8 billion in cash on hand and a completely untouched $10 billion revolving credit facility.
And look, the liquidity buffer is solid for standard operational hiccups. However, the sheer scale of the debt load fundamentally changes the risk profile for a retail shareholder.
Absolutely.
When a company carries $78.5 billion in debt, engages in aggressive M&A by buying into Lumos and Metronet, and commits $30 billion to buybacks, they are operating with incredibly thin margins for macroeconomic error.
They're essentially using debt-fueled leverage to buy back their own stock. And the math works beautifully when you can borrow at low rates and your top-line ARPA is growing. But what happens if the music stops?
That's the billion-dollar question.
If that 13% drop in postpaid net account additions accelerates, or if that soaring bad debt we saw earlier is an early indicator of consumer exhaustion, the cash flow engine slows down. But the debt servicing costs and the dividend commitments are fixed.
Right, and that is the structural risk of modern financial engineering. T-Mobile has designed a capital structure that assumes flawless operational execution and basically uninterrupted integration of their acquired assets.
Which is a big assumption.
A huge assumption. If the bad debt expense continues to scale by 50% year over year, or if the multi-billion-dollar fiber investments take 3 years longer to yield positive cash flows than projected, that $78.5 billion debt load transforms.
It goes from manageable leverage to a suffocating weight.
Exactly. It severely limits their strategic flexibility, and retail shareholders holding the bag when growth stalls will bear the absolute brunt of that leverage.
Which leaves us with a really fascinating broader industry question to ponder as we wrap up this deep dive. Think about T-Mobile's brand identity. Over the last decade, they branded themselves as the Un-carrier.
The pink shirts.
The scrappy disruptors in the pink shirts. They eliminated predatory contracts, mocked the legacy carriers, and forced the entire wireless industry to adapt to consumer-friendly rules.
And they leveraged that disruptive identity to acquire the massive subscriber base they're monetizing today.
Right, but look at the mechanics of Q2 2026. They are forcing customers onto tax and fee exclusive plans to subtly hike prices. They are closing smaller local dealers to build massive corporate experience stores. They are laying off layers of management, buying up regional competitors like US Cellular, investing billions in rural fiber networks, and quite literally forming joint ventures with AT&T and Verizon.
Yeah, it's quite the shift.
So the question for you to mull over as an investor is this. Are they losing the disruptor DNA that got them here? In the relentless quest for scale, cash flow, and margin expansion, is the Un-carrier simply transforming into the exact type of legacy telecom giant they spent the last decade fighting?
Well, it is the inevitable life cycle of a corporate disruptor, I think. When you achieve this level of market share, the sheer physics of maintaining growth require adopting the very strategies of consolidation and premium pricing you initially opposed.
It's true.
The defining story for the stock over the next several years will be whether they can maintain the facade of the Un-carrier brand while executing the operational playbook of a legacy monopoly.
A story we will definitely be tracking closely as the fiber joint ventures begin to actually hit the balance sheet. For you retail investors looking to stay ahead of the curve, make sure you follow the show for daily, no-nonsense earnings coverage just like this. We will see you on the next deep dive.